I've come up with since the publication of my book, Trading for a Living. It's we haven't done a seminar like that, or I haven't done a seminar like that for a long time, as they say, into practice. And I found that I'm better off staying in front of the screen and trading. But still, every once in a while, do a seminar. And so this is it. The first time in 2 years, and probably the last one for a long time. One of the most pleasant experiences I have, and it's an experience that happens usually a few times a year. Someone comes up to me at a conference or at a trade show and thanks me for what I taught at some seminar in the past. By the way, can you hear me okay in the back of the room, or should I use a microphone? Is it better with a microphone? And thank me for it. I taught them. They're doing very well. They're managing money. They're trading their own account. And whenever I hear somebody say that to me, I always ask myself, well, how come? Another thing to really know them emotionally and apply them in what you do. And so the success in trading ultimately depends on you. I'm going to give you as much information as can be humanly squeezed into a single day. And if you have questions after this seminar, you can call me and I'll be very happy to clarify them for you over the phone. But the thing is, whatever you're learning today, you have to go home and really apply. Trading is a lot of work. I notice in my own trading the amount of homework I'm doing every day. I used to be able to review, 5-6 years ago, I would review all the markets and it would take me 15 minutes. And now I follow fewer markets and it takes me at least 2 hours a day to do my homework. So it's either I'm slowing down in my old age, or our plan for today. We will touch upon 3 topics: psychology of trading, technical analysis and trading systems, and money management. Perhaps the most important topic. And when it comes to trading psychology, there are really 2 aspects to that. Individual, especially in the futures markets. 80 to 90% of people lose money and wash out of the markets. An average lifetime of a speculator is 2 years. After 2 years have passed by, most people are no longer participating in the markets. And if you look at those numbers, you've got to ask yourself, why would this like a horse race, chess game, and a card game all rolled into one? And this game goes on almost 24 hours a day. So if you're in the mood for some excitement, you can always turn on a monitor and make money. But in fact, they're looking for entertainment value. As a noted philosopher once said, most people live lives of quiet desperation. Wake up in the most stupid show on TV, go to sleep. Next morning, wake up again. And the only thing to look forward to that 4 months down the road, you have a vacation coming up and you're going to go to the airport and join a group, and the plane is going to land in Paris, and you're going to get on a bus and have 50 minutes in front of the Triumphal Arch, and then 15 minutes in front of some other place, and back on the bus. And then back home and back to the office, beer, TV, sleep, wake up. So that's how there is a very comforting feeling in living life, sort of as if on a rail, but there is also a sense of deadness about it all. And so a person picks up the phone and says, he's turned in a knot, and his face is into the monitor, and he is calling his broker every 2 minutes to find out what's the latest. Even then, adrenaline is pulsing through him, and this is better than this kind of living death that most people are living. And so people get involved in this exciting game, whether the market goes their way or against them. People often approach the market with some kind of rational expectation, rational wish to make money. But once in this self-destructive, exciting game, because once we begin to look for excitement in the markets, we're finished. There is a surprise to me when I realized that the method of AA could be applicable to trading. I'll just take 2 minutes to describe how it is, because it certainly turned my trading life around, and I hope it can help you. One day, I was going to this party at the Department of Psychiatry, and I had a couple of hours to kill. So I met with this friend of mine who was going to that party too. And she said, they talked about, and I thought about how I was preoccupied with losses. They talked about playing those little games, switching from beer to wine to hard liquor. And I thought about my switching between futures, and most people cannot do that. Why can't they do it? Well, because if you admit that you're an alcoholic, then I'm only going to drink on weekends. No more drinking on weekdays. And to me, it's like when an alcoholic says something like that, it's like a driver who loses control. Sort of raw, in your face kind of name. With Alcoholics Anonymous don't call themselves Drinkers Anonymous. It's alcoholics. So we would call ourselves Losers Anonymous. And we would get up in front of the group and say, "Without a loss." I can immediately hear an objection. What do you mean to go to sleep without a loss? What happens if you buy some places? Suppose a truck pulls up to your stand, and a salesman jumps out and says, "Look, we have this exotic fruit from South America. It's really not well known in New York, but why don't you buy a couple of crates? I'm in a huge hurry. I have to return back to Mexico, Guatemala right away. So I'm selling this whole load, dirt cheap. You can really make out like a bandit." The fruit is so... Suddenly they start thinking that here is the trade where they're going to make their half a year's income in the next week. And suddenly the whole sense of damage control and counting money goes on a daily basis. But that is done at home in the evening. I come into the office and I have live data feed coming into the office. The computer has been on all night, and I just push the button to turn on the screen. My name is Alex, and I am a loser. I have it in me to do serious financial damage to my account. I've done it before, and I can certainly do it again. So my only goal for today is to trade sober, time after time after time. There are several findings that social psychologists have made that are very relevant to traders. And one of them is something that every trader should know. Social psychologists in the 50s have conducted an experiment. They hired these volunteers at some kind of minimum hourly wage, mostly college kids. And they said to them that they were going to test perceptual ability, to smoke glass, and then they put a guy on the street and stuffed his pockets with dollar bills. And he was just standing in the street and saying, can I give you some money? Can I give you some money? Free money. So one of their more famous gurus, who shall remain nameless, and I said, you said to call you if I see something something very interesting. And I think I see it. I think I want to sell silver. It's everybody's long. Say, yeah, everybody's long. We have 85% bullish consensus in silver. Everybody is bullish silver. No way they would put me on TV to say something like that. It gets bigger and it gets smaller based on the actions of total strangers, and it's a very sort of unsettling thing for most of us. So at that point you start watching price, going like this, but the guy is rocking, and after a while the snake gets into the same rocking movement, and so he has the snake hypnotized. So here you're doing this thing with the market, up and down. Most important thing he picked up was this tale I told a long time ago. It's actually a myth of Odysseus. In the Odysseus is in fact that all the seamen jump into the sea and swim to the rocks, and once they get to the rocks, sirens eat them. Not a good situation. It's like total wipeout that he has to be there. So he starts tearing at the ropes and yelling to his crew, which doesn't do much good because they can't hear, and gesticulating to them to untie him. But they're under strict orders not to untie him, and so he continues to struggle against the ropes until the rocks are no longer visible, and his crew cleans out their own ears and comes and unties him, and he's all tired and spent, and he realizes his trading system saved him. In other words, the trading decision was made before the markets opened, and while the markets opened, he traded his system. So it's okay to change and adapt your system, but you should never make trading decisions while the markets are open. Starts walking away and suddenly realizes that he has no business being short S&Ps, that according to his system, he didn't have to sell anything short. If anything, his system was bullish overall, and in the short run, kind of neutral, but that he needed just to do something because this, he felt so powerless after being chewed out by his boss that he had to do something active. And so that's why he put on this trade. As in one of the most powerful rallies of the year. Had he stayed in the trade, he would have really lost a lot of money. And the decision, the realization that he got was that the reason he was putting on the trade was not to make money. At that point, you're going to start being sucked in by the markets. Even something as simple as watching quotes during the day can be very hypnotizing. Just watching the method. How do we go looking for trades? As far as trading psychology is concerned, there are really two aspects: individual psychology of trading and mass psychology of the markets. Individual psychology of trading, most people get in to make money and wind up just being very, very excited by the game. And once a person gets excited and expects to make a lot of money in a hurry, they're not careful. And people who are not careful don't survive in the markets for very long. In order to be a disciplined trader, I mean, there are rules everywhere you go. But there is one place in the world there are no rules, and that's the markets, the financial markets. As long as you have margin in your account, you can do anything you like. You want to go long 10 S&Ps and balance it out by selling short 10,000 shares of IBM and maybe balance this kind of situation where everything is permitted. Intoxicates people. And so we have to always think about being rational. I recommend using the principles of alcohol in this kind of addictive behavior and how they rebuild themselves and crawl back. Well, that's what you're going to have to do as a trader. So anytime, I think every trader should take themselves to an AA meeting, and especially one of the more successful young future traders, relatively young future traders, in the country. I promised a magazine to write an interview, putting them together into a trading system. Let us start with something very basic, a simple bar chart. I'm just showing this chart because I want us all to agree on certain basic definitions. Great place to cover and go along. The only problem with this approach is that it's very visible in the middle of the chart. Is decide how to make decision at the right edge of the chart. Because the middle is easy. Incidentally, most seminars you're going to go to will show you great trading signals, but it will cut through with bearish divergences. I think it's at an important top and it's about to go down 100 Dow points any day now. And so you put on a short position there. In order to be a successful trader, you don't want to forecast. What you want to do is manage. You have to say, is the market more bullish or more bearish? And based on that, are you going to manage this incoming information? Markets are telling you something all the time. How to read that language and how to manage your position in accordance with the data that comes in. Not to forecast, but to manage. The trend is moving. What the indicators are saying. Then you go down to daily charts and you do the same thing for the daily. Describe. And then only then at the end you say, what am I going to do with this? Am I going to go long or am I going to go short? And at what level? But you see what I mean? The information comes in. You analyze that information and you decide which way to flow. It's telling us, first of all, a highly important point on which I hope we can all agree at this early stage, is that what is price? And you have equity in your account, and you're interested in, let's say, gold or S&P, and you think it's underpriced. So why you're not buying? Go ahead and place your order. Want to buy as cheaply as possible. The sellers want to sell as expensively as possible. And so they are like two camps apart from each other, but they are surrounded by undecided traders who can butt in any moment. And so the greediest buyer, somebody who really got to have it, steps up and bids one tick higher, or the most fearful seller, the one who is really afraid of getting stuck with merchandise, lowers his price and sells it for agrees to sell for one tick lower, and that's when the two people meet, and a transaction takes place. And so every single price that occurs represents the consensus of value of all market participants at the time of the trade. Of all participants between bulls, bears, and undecided traders. We're running our little Gallup poll, so to speak. It's an election is coming up, and a guy goes out with a clipboard on a street corner, or now they do it mostly by phone, and he says, "Sir, are you voting for Clinton or Bush?" "Thank you, sir." "Madam, Clinton," and the rest are just plain disgusted, and gives those numbers to the politicians so they know how they can lie better. And what we need to do as traders is to figure out which party is winning in the market and then bet on the winning party. We have a two-party system, bulls or bears, and we have to conduct a public opinion poll and decide which party to bet on. And the thing is, you cannot afford any kind of party allegiance in the markets. I used to have this friend, some of you may know Ralph Keita. He died last year. He was writing this, but the guy was a great journalist, not such a good trader. But the thing is, you cannot afford to have some kind of allegiance to bulls or bears in the markets. You just have to decide which party is stronger and bet on the winning party. Or if you don't have a strong opinion, just don't make a bet. You don't have to trade every day. You don't even have to trade every week. A few good trades a year will... For example, you can see that some bars are very narrow and some bars are very wide. What does the length of the bar tell you about the emotional temperature of the markets? When is this kind of wild ride are not very high? Also, some other important pieces of information. The relationship between opening, closing prices, high and low. Opening price, who trades at the open? Somebody who has a daytime job, comes home in the evening, reads the newspaper, analyzes the markets, and as often as not, calls his broker and says, buy me 100 AT&T tomorrow at the open, or sell short pork bellies at the open. And before the markets also accumulate. So in the morning, 5-10 minutes before the opening bell, the traders are in the pit in commodity markets, and that's when the pros start covering their shorts. And vice versa, when there is a big inflow of sell orders, they will open the market lower, so that the public wants to sell, they will buy it from them, but they will buy it at a discount, so that the slightest bounce, the floor can make money. And then the market opens and begins to trade, and gradually this kind of public selling, and actually came up with an idea myself, I'm going to test it probably next week. Also, another very important point is what is the relationship of the high or the low price and closing. To 164, about 10 points, so we should expect a decline to approximately, well, right about here, back to the base. And all this kind of great classical charting. There is only one. Whenever I have an opinion on the market, my fingers start going like this, and my ruler just slants a little bit to give more support to my opinion. So because of that, I start telling you what they see on that ink blot. Well, I think classical charting, unfortunately, is to a very large extent a Rorschach test. You see what you want to see. So because of that, I only go on anything shorter term, only exponential. What does a moving average do? Before we start deciding its trading signals, we have to decide what it measures. Remember, any kind of crossover, but the direction of its slope, is it sloping up or is it sloping down? And you see why it makes sense. It's like a composite photograph taking place in front of your very eyes. You look at the British pound here, and it looks like a double top. Maybe you should sell short against it. What is the message of the moving average, though? What is it telling you about this market? Is it bullish or bearish? Optimistic or pessimistic? Suppose you look at this chart and you say, based on fundamental information, you're bearish the British pound. You don't want to buy it. Can you step aside? Yeah, it's perfectly all right to step aside. But what is not all right is to go against the tide. Basically, this moving average serves as a... Now, the problem with this moving average is that the biggest problem with this moving average is it's going to be doing this, or you see here this, here whipsaws, here, so it goes down and then back up again, can lose a lot of money. So the price 2-day moving average a little slower, 3-day a little slower. 13-day I found, in my book, when I wrote it, it was mostly 13-day EMA. I have pretty much stopped using that. Happens to the same chart. We're going to apply all these indicators to one and the same chart. Let's apply them to the chart of the British pound. Let's go from 13 days to 22 days. And you can see how the number of the slow moving average changed its trend when the move was halfway over. So here we have to find some kind of trade-off between using a very... For those of you who have read my book, you know that I used to place a great significance on MACD histogram, and actually that was the key point of triple screen trading system, that the slope of MACD histogram told me whether to trade the market from the long side or the short side. As time went on, I found that MACD histogram was just way too wiggly. It's a highly useful indicator, and I will show you many instances when I still watch it every day, and all the weekly charts and all the daily charts I analyze. Here is a very important point. When we start looking for buying and selling points, there are two types called value buying and the other greater fool theory buying. Value buying is when you buy something at a fair price and you expect it to appreciate. It's rising. If you buy it somewhere in this vicinity in October, near its exponential moving average, you know that you're buying close to value when a moving average is rising and prices have reacted back towards the moving average. We want to sell short when the moving average is declining and prices have rallied back up to the moving average. The trouble is that we have put on this long-term moving average, which is very recent, something that didn't make it into a book, is a dual moving average. Let me show you what I mean. This is chart number 7, and it shows the same British pound, but it has, and we're going to place our buy orders at the 13-day exponential moving average. So we're going to try and buy value as defined as in a free fall. Imagine that every day you calculate this moving average and place orders to sell at the moving average. Very often the market will rally just for opportunity. What happens if you go, if it's a reversal? What happens, for example, here at the top? You don't know that the trend is going to reverse. You buy it here. Well, if you buy reverses, then you're really hurting. Yes, sir?
Let's say you went to a different market or a stock or whatever. Would you just in general use a 13-inch?
Okay. This depends on how many markets you're trading. If you're trading...
what works best? Back to see how it followed the chart.
Right. The long-term moving average, the one that gives me the trend, I want to adjust it to the point where the average, fine-tune it to the point that when prices come stabbing down, they meet your moving average at the stab point.
So in other words, you're trying to adjust the crossovers of those two moving averages to where the market...
The average is rising, the channel is rising at a certain distance away from it. And a Bollinger Band gets wider or narrower depending on how volatile the market is. And Bollinger Bands go to a very wide spread and then the market comes and hits the Bollinger Band. Well, at that point, you probably should be writing options. In other words, Bollinger Bands show you, or Forex or what have you, I think it's much better to use a standard channel, just parallel to the moving average. And now we have to make the decision how wide to make this channel. For into math, you will recognize that as second standard deviation. Is to design this channel in such a way that when prices are inside of it, that's normal. And when prices are... Silver used to trade for $4 an ounce. Actually, it was even cheaper 5 years earlier, but that's another story. But it had this huge run-up where it... And ever since that spike, silver had this long, drawn-out decline. Then look what happened in 1992. You see, it established. This is how a market builds a base. Goes to a low, tries to shove itself below that low, comes back above it, and then you know that the grounds are laid for a rally. Now, obviously, when you're looking at a monthly chart, you expect for this process to take years. If you're looking at a daily chart, the process should be completed in a few days or weeks. But the logic is the same. There is a support, the market tries to push itself below support, and when it pulls back above the break point, that's when you want to start buying the thing. So it had a very nice rally in 94. Silver makes a new high and an equal high almost, and meanwhile MACD histogram makes lower and lower tops. It's a very strong bearish divergence giving a sell signal. Stochastic is turning up, and MACD histogram is trending higher. This is a market that's really feeling for a bottom. In December, bears were this strong, and here in February, bears are only this strong. So prices are just as low, and bears are weaker. If one party is losing an election, based on chart, based on price action prior to that. In other words, I would not put my stop at the opposite edge of the trading range. My inclination would be to act right away on a thing like that, and then just put a stop.
Oh, I see. Take a chance.
Take a chance, but take a chance on a very tight money stop. Over.
You're comparing.
That's right. That's right.
Say that again. I lost it.
This is what you see on the screen now is a page from Monday's Investors Business Daily, and this page tells you powerful leverage in silver.
I see. Okay. I'm looking at the charts.
Is that it gives you a directory of securities and directory of templates, and we're going to, let's say, load up silver. What this thing does now, it gives us 3 charts. Weekly buy signals were coming on silver across the board, and of course I had no idea just how dynamic the move was going to be. 45 cents one day, but the signals were there, because most people are more often bullish than bearish. Every once in a while those numbers become very slanted, and lately in silver bullish consensus was running above 80%. I think it was 80. So if 80% of people are bullish and 20% of people are bearish, then an average bear has 4 times as much money as an average bull. So the big money is on the short side. You know, while all the papers are telling you invest in silver futures and options, you know, is this a buying opportunity or is this a selling opportunity? Looks like a selling opportunity. Sell this thing short. So this is the weekly chart. The weekly chart doesn't give you the price where to buy or sell, but the weekly chart says this is the market that you shouldn't be buying. That if you're low, it was 10 cents. Is it getting stronger or weaker? You know, you don't have, you know, it's no high level math. You can see that it moves in these waves, and waves for that market. So then I go and open that market. So we have weekly and daily beans. Which one we're looking at first? All right. Cheap now as they were in the early 70s. And how many things you know that cost as much today as they cost in the early 70s? And beans are an essential commodity. That's what. Let me show you the monthly chart on the soybeans. It's the kind of thing that you sit in front of the chart for 10-15 minutes and it occurs to you. And if you don't write it down, you're not going to remember. I don't remember it the next day. But if you write stuff like that, it sort of forces you to be honest and forces you to remember your own history. So I made a lot of money, made a substantial amount of money in beans, and beans crossed the crucial level of $6. So now I had to buy some more. And of course, timing was completely off because the day after I bought, they just sold off, and I didn't even have a good stop in. I short. Right? So if we go back, let me go back to my own notes, and it says daily EMA down, prices breaking to new lows confirmed by indicators. Money management, because that's a key aspect. Then we'll look at some more markets. Let me tell you a sad story first. Money management. I have this friend who is a very super powerful trading system, which he back tested going back 20 years and trading a nice handful of markets, from pork bellies to Swiss franc, and tremendous for some people who had the money, and showed them the system, and they were tremendous to trade or putting together a fund to trade his system. But while the fund was being organized, they gave him what they called a small account, $100,000, that he should trade this account with his system, and they were going to watch how it goes, the whole thing. So I was on my way to California, and he invited me to come stay with him, and I brought my son with shovels and food into a convertible, and drove out into high California Sierra, camped out in the desert, and he took. We're not going to jump like that. They're closed anyway. We come to his house, go to the basement, and he has a basement with a view of the Pacific Ocean. Go to the basement to look at the monitors. It's deep. So if markets start going against you, if you're out of sync with the markets, you should stop before there is any serious damage. Then the question, how deep can you allow this hole to become? There have been studies done that show that the highest number compatible with long-term account. If I have a $10,000 account, if I have a $5,000 account, what can I trade with that account? Well, not very much. Not very much. But those are the numbers compatible with long-term survival. I added them to the stock market and found that he would have done spectacularly well in 1929 crash. He was very pleased with himself. He's doing very well now, and he would have done very well then using the same methods. What's the project for the that's the way to do it. What happens, why such a low number? Imagine you are trading 100. 2% is a very low number. You can lose 2% several times. And after you're done losing it, you still don't have too much to make up. And that's how much money you can afford to lose from your total equity until you stop trading for the rest of that month. The institutions hire these kids mostly in their early 20s, straight out of college, and they like to take sort of athletic kids who are used to listening to the coach. And they give them some training, not an awful lot, lose a little. You come to a monthly limit, and it's 15th of the month. Well, what happens on the 16th? You still come to work, draw your salary, no bonus, of course. But most of them are back looking for a job, can't make money. How come? Because when they left, they took the quote system, the contacts, the Rolodex, the everything. But there's one thing they didn't. And so people go back looking for a job because when they left the company, the discipline that was imposed on them from the outside is no longer see if there's anything. That's how he uses it. Alex, I have this idea. See if you see anything wrong about it. Doesn't look for praise, looks for challenge. And so he runs his trading system by me. What do you think? And I say, well, I don't understand why he's calling me, because this is the same system he described to me a few weeks prior, and we discussed it. It sounded like a very sensible system. Nothing has changed. Why are you calling me again? Quotes a 6/8% rule. We all go through periods in the markets where everything we're just on top of them, and everything we touch turns to gold. And then we go through other periods in the markets when everything we touch turns into a completely different substance. And that's what the rule is designed to ensure us against. If you are 6% down from your starting equity for the month, the market is telling you something. The market is telling you you're called. And if you're called, stop trading for the rest of this. This allows you to take one more trade before the month is out. That's why 6/8%. Another thing which I began to do as my account increased, I sort of mentally subdivide my trades into 1, 2, or 3. If I just feel like okay about a trade, I will try to put 1/3 of 2% at risk. If I feel strongly about the trade, I will risk 2/3. And it's only for those trades where I'm so bullish or so bearish that I have steam coming out of my ears that I will risk.
How about when it go back to even? No.
You know, you've got to ratchet it. You've got to put this wheel that goes only one way. You know, anytime we'll under the market.
Or you could do it mentally.
You can do it mentally, right? If you know you have the discipline, and mental doesn't mean just look, which lend themselves to this kind of catastrophic outcome much better than others. For example, if you sell options, well, you've got to, first of all, you've got to be aware which situations are more prone to put you into a catastrophic risk mode. Selling grains in summer badly hurt. In the long run, once you become successful, you've got to take some money off of the table. It also happens to be one of those things that when you're aware of those risks, those situations are much, much less likely to happen. It's like if you walk through the town like a tourist with a camera on your belly and your jaw hanging on your chest and looking up at the roofs of the skyscrapers, the chances of you being mugged are, if you sort of keep yourself organized and looking out for trouble, chances of you actually being hit with troubles go down substantially. Someone asked me, there was, of course, this famous case a few years ago of an advisor who allegedly ran $10,000 into $1 million in the course of a trading contest, although it has been documented in a book. He made them, but that he lost them. Basically trading multiple accounts and lost money in all accounts except for one which made $1 million. How that could happen, I'll leave to your imagination. Well, you know, after he made his $25,000, he had to pay rent. He had to eat, not very much, but still. The government wanted to have when I saw him last year in March, he had $11 million under management. And by the time I saw him again in September, October, he had closer to $30 million under management. He collected 20% of that as his incentive fee. No, they didn't give him any management fee, but he collected 20% of $4 million as his incentive fee. So he earned $800,000. You just have a contractual relationship with the Commodities Corp, so you don't need to be a CTA. Because basically, you know, you have to be a CTA. So if you approach your neighbor down the street and say, "Hey, I'm going to manage your account," and I tell you, it was one of the easiest exams I've taken. The only thing that was easier when I was 17, I had to take an exam in what was called, get that, scientific communism, and out of California. And they just have a little box on the front of every book of charts that comes out, and it gives you bullish consensus number for every market that they have those numbers for. So actually what I do, you know, markets can go up only on new blood. new suckers have to come in and buy, basically. And if bullish consensus is 85%, there is not a heck of a lot of to run up to 180. And what you've got to watch in a market like this, it runs up pretty much vertical. And then there is this really sluggish week, no new high. Well, what's next? It's like everybody got excited, let's do it, and running to the upside, and now there is a little narrow inside week. What's likely to happen next? Start running again? Plenty of opportunity to go short. And then it reacts right back down to the moving average. So here around 175, you could have sold it short and short and short.
Dr. Elder,
Yeah.
the cotton also was pretty, reached the high of
You know, there's one market I never traded, cotton. I mean, we can look at it if you like. Let's look at a market about which indicators are toppy. Let me sell bonds short. Bullish consensus was about 70% at that point. So I thought that bonds came into the office very bearish, and bonds or that well if you're bullish. So several points to every trade: getting an entry point, managing money, getting an exit point. I thought that my entry point was very good. You come in bearish and the market opens at the highs, and you watch it, and it just hangs there, and one tick down, one up, two down, one up, two down, one up, and you see that it's not flying. Sell it short and catch this whole downdraft. Well, false breakout to the upside. Now you expect it to really go down to the moving average. I mean, I expected to be taking profits around 103 in bonds. Except it doesn't happen. They just hang and they start going against you. Well, remember, one of the most important rules: don't allow a winning trade to run into a loss. So just grab what little money is left on the table and go home. How does one go designing a logical trading system? All right, Eurodollars. Again, without looking at the last bar, which you can see this bear market. And early this year, there is a rally, decline, and another rally. And what would you say at this point?
Whichever's
I sometimes
before
do
you
that.
flip automatically.
To flip automatically. As far as entering positions one tick above or one tick below, with live data feed.
Check that position. How much do you let it wander back down past its breakout point without, without it's telling you that it's wrong, that you're mistaken in reversing? How much do you risk on a trade? I mean, the bonds you might put up the day.
6 area and buy them. I would put my stops right inside that range, and it's sort of like if
The moment it went up over 106, what would you do? Put it right under the breakout at 105.28 or 105.24?
105.24 probably in the congestion area.
On the theory that if it's good, it should just
It should go right. It should not right. The rocket should not return. Basically, bullish consensus numbers.
Yes.
Lots of brokers have them. You really ought to be able to get them for free.
Do you use those charts for anything other than just getting that bullish consensus number?
For that and for mind, method, and money. Or as a friend of mine once said, 3 Bs: brains, balls, and bankroll. First of all, you have to get your trading psychology in order. So to bring yourself, if you were trading for an institution, you would have a boss who would bring you down to earth and constantly do equity runs and set limits. Have it, and I've never seen a loser with a good money management. Money management means that at any given point, you know how much of your capital is at risk in every position that you have, and how much is. As I said in the example that's in your handouts, imagine if I took a board, put it here on the carpet, and said, "Can you walk from one end of the room to the other?" No sweat. Now I'm going to take the same board and flip it to the opposite side of the street and say, "Just walk across the street." Now most people would not be able to do it. Why not? Because the stakes are very high, and so because of that, you're going to get stiff, and you won't be able to walk across that board. You won't have the coordination because the fear factor will be too much. Well, same thing in trading. If you want to sell short to some sensible minimum, and that sensible minimum includes 2% per trade, maximum drawdown, 6% per month, maximum drawdown. Having said that, we have to go to the method. How are we going to analyze the markets? And to analyze the markets, we have to, first of all, we have to analyze them in several time frames. We have to have analysis that's more sophisticated. If everybody is looking at the daily charts, you look at the weeklies first. Make a trading decision on the weeklies and then return to the dailies only for entry points. Another point, if you trade against the moving average using an extra tight stop, realize that you're entering the you're going against the tide, possibly. What kind of oscillators to use? Well, the best oscillator is an envelope or a channel, because that gives you an idea of what's normal and what's abnormal about the markets. Basically, you want to buy on it and try to figure out on the weekly charts, are we in an up move or in a down move or in some kind of turning point. And then once I made my decision on the weekly charts, I go down to the dailies and use daily cycles, and you really have to put a lot of time working with the markets. One way which I found very, very useful is I always keep my word processing document open at the same time as I have my chart open on the same. I'm writing a report on the market. And incidentally, several people have asked me whether it's available, whether they can buy it. Absolutely not. I mean, I can show it in a situation like this, but including all the uncertainties that you have. So you have to keep this thing very private for yourself. And I think I've shown you some examples where I write.
Particularly with the example of the rising trend, and you want to trade below the EMA. Can you just give a few examples of that and how you short or to sell off when it hits the upper channel line, or when it goes above and then coming back down?
It depends. It depends. If the move is young, I will probably stay with it a little longer. It depends. It depends what the indicators are doing. Usually you have a little more time to sell than you have to buy, because bottoms tend to be quick affairs and tops tend to be broader, allowing you time to decide and to act. And basically, bottoms are made on fear. Most people I talk to are bearish on the stock market, and I don't do. Pardon me?
Highs, new lows, comparison.
Okay, well, new highs in the New York Stock Exchange. I think Friday was like 125 new highs. All right.
Some guys have everything.
396.
396 new highs.
61.
Okay, you're looking at the weekly charts.
Are you looking for the daily?
I'm looking at the daily. I think you're saying the weekly
daily.
charts.
He's giving you weekly. The daily figures on Monday
Friday.
were 102 highs, 17 lows. Tuesday was 105 highs, 19 lows. Wednesday was 128 to 15. Thursday was 204 to 24, and Friday was 102.
Very wrong military. They told us there were no bad soldiers, only bad officers. And basically, if you look at the New York Stock Exchange,